Hey guys, welcome back to another episode of Tax Planning on the Whiteboard. My name is Jeff Montgomery, Certified Tax Planning Specialist, also owner of Montgomery Financial, and today we are going to talk about Qualified Charitable Distributions, better known as QCDs. Quick disclaimer out there, please do not enact any strategies you hear on today's show. Strategies are very personalized and would pertain to your personal situation only, so please contact your tax professional or your financial professional to go over any strategies that you hear today. If you don't have help in that area, please feel free to reach out to us. We are in multiple states and can service folks nationwide. So without further ado, let's go to Tax Planning on the Whiteboard, and we're going to discuss QCDs. Are they a magic income AGI reducer? Okay, welcome to the show, guys. On our whiteboard today, we're going to go over a couple concepts with qualified charitable distributions and some rules following those, because there are specific ordering rules in order to take out money and have that qualify as a charitable distribution directly from an IRA account to a charity, commonly called a QCD. So let's just go over a couple tax buckets here. Everybody has seen probably this presentation from me before. We have our taxed later bucket here. So these are accounts that are taxed later on in life. They are tax deferred. And typically what we have in here is we have the good old 401k, right? We have maybe a 403b, maybe a 457b. There's a variety of accounts in here, but we also have the traditional IRA, okay? Now, the thing that's interesting about a QCD, and I'll kind of, pardon my drawing skills here, we'll say that this is a charity over here. And the thing about a QCD that's really interesting is you cannot do a QCD from a 401k or a 403b or a 457b. So these are not eligible. You have to do it from an IRA directly to the charity. Couple other rules out there. So if we write rules over here, one of the rules, pretty interesting, is the old 70.5 rule. So in order to do a qualified charitable distribution, you have to be 70.5 years or older. Now, based on the Secure Act and the Secure Act 2.0, required minimum distributions do not start until age 73, okay, or 75, okay? So if you were born after 1960, your required minimum distribution age is age 75. And we do know the year you turn 75 in that example, or 73 if that's where you fall, they do give you a little bit of a grace period until April 1st of the following year after you turn age 75. But please keep in mind, you would have to take out 2 minimum distributions that year if you do use that grace period rule. So let's keep a couple of these rules in mind when we're discussing our first example in doing a QCD and doing it the proper way. So let's go ahead and erase these. Now, what we're going to do is we're going to say we have Mary, okay? Mary is 74 years old, all right? Mary's age is 74. And Mary has a required minimum distribution of $15,000, okay? $15,000. Now, Mary, in this situation, has already taken out her RMD. So she already took the RMD. And just through a calculation that we did, her adjusted gross income is $100,000. Okay, so that's what we're working on. Mary then says, hey, you know what? That was great. Took that $15,000 out. I went on a trip with my girlfriends. It was awesome. Now I want to do a QCD. And she wants to do a $8,000 QCD from her IRA, okay, directly to the charity. Okay? She wants to send $8,000 from her IRA directly to the charity. The question is, does that reduce her adjusted gross income down to $92,000 from $100,000? Remember, she already took her RMD. You probably can guess. The answer is no. It is not a magic AGI reducer because she already satisfied her required minimum distribution and then wanted to do a QCD. Now, if she does send it directly from the IRA, directly to the charity, it will not increase her AGI. It's basically a wash. Her AGI remains at $100,000. So now let's fast forward and let's go to the following year. So we're in the next year. Mary is now 75. So let's change this to 75. Let's just say her RMD remained at $15,000. Let's just use that as an example. Her AGI is expected to be $100,000. But this time, what Mary does is she does a little bit of planning and she plans ahead. And she says, you know what? I don't need $15,000 for a trip. What I would like to do is I would like to spend $7,000 on a trip and send $8,000 as a QCD directly to the charity. So she takes her $7,000 RMD. Her total RMD is 15. She takes that $7,000 and she puts it right into her checking account. Maybe she withholds taxes, maybe she doesn't. The $8,000 to make up the 15 goes directly to the charity. So now $7,000 in her pocket, $8,000 directly to the charity. What is Mary's AGI? Well, Mary's AGI is now lower by $8,000. Down to $92,000 as opposed to $100,000. And it's because Mary did it the proper way. The IRS has this rule where the first money out of an IRA is always going to satisfy the required minimum distribution. So the first way Mary did it, she had already taken that $15,000, already put it in her checking account and went on a wonderful trip. The second way, the second year how she did it was she took $7,000, put it in her checking account, $8,000 directly to the charity. Her AGI is reduced to $92,000. And AGI is an important thing to keep track of because our tax code has many tax triggers, and many of those tax triggers are based on that adjusted gross income number. So we got to keep that in mind when we're doing tax planning. Very, very important. So that's how QCDs work, guys. This was a quick tax planning on the whiteboard. Please reach out. Feel free to call us if you have any questions whatsoever. My name is Jeff Montgomery, Certified Tax Specialist, and we'll see you next time on Tax Planning on the Whiteboard.